The average American with credit card debt is paying nearly 20% interest right now. That means if you have 15,000 in credit card debt, you're handing over 3,000 a year to the banks. Money that could go towards your retirement, your kids' education, or building real wealth. What if instead of giving that money to the banks, you could pay it to yourself? That's the power of the infinite banking concept. And today I'm going to walk through the exact 5-step process to create your own banking system using life insurance. This isn't a get rich quick, it's a mathematical strategy the wealthy have been using for generations. What if I told you the banks have designed a system that keeps you paying them forever? You know those credit card statements that come in the mail every month? They're not just reminders to pay, they're engineered to maximize profits while keeping you trapped in debt for decades. Let me show you exactly how it works. Let's look at something most people don't realize about minimum payments. The formula banks use isn't random. It's carefully calculated to extract the maximum amount of interest from you while giving you the illusion you're making progress. Most credit cards set a minimum payment at just 2 to 3% of your balance. And that sounds reasonable, right? Here's what happens with a typical $15,000 credit card balance at 20% interest. When you make those minimum payments, the payment starts around $450 per month, but as your balance slowly decreases, so does your minimum payment. It seems helpful, but this is exactly how they trap you. Making only these minimum payments, it would take you over 30 years to pay off that $15,000 balance. And here's the kicker. You'd end up paying more than $24,000 in interest alone. That's paying your original debt almost 2.5 times over. Credit card companies use something called front-loaded interest that works completely against you. Each monthly payment gets applied to interest first, then whatever's left over goes to your principal. When you're early in your repayment journey, almost your entire payment goes straight to the bank's pockets as interest. On that $15,000 balance with a $450 minimum payment, only about $200 actually reduces your debt. The rest, about $250, is pure profit for the banks. This system is incredibly profitable for credit card companies. Last year alone, they raked in over $130 billion just from interest and fees, not million, billion with a B. That's more than the GDP of many countries, all coming straight from consumers' pockets. Now, let's break down a typical payment cycle. Say you have $15,000 as a balance at 20% interest with a minimum payment of $450. In your first payment, $250 goes to interest and only $200 reduces your principal. The next month, your balance is $14,800. So your interest charge is slightly less, maybe $247. Your minimum payment also drops slightly to maybe $444. So now $247 goes to interest and $197 to principal. See the pattern? The principal reduction stays roughly the same while your payment amount decreases, stretching out your repayment timeline. Now, you might be thinking, I know about this. That's why I use the debt snowball or avalanche method. These conventional approaches are definitely better than minimum payments. With the snowball method, you pay off your smallest balances first for psychological wins. With the avalanche, you target your highest interest rate first to save money. Both are solid strategies, but here's what nobody tells you. You're still losing thousands of dollars in interest using these methods. Even with the most efficient avalanche method, paying an extra $500 monthly beyond minimums on a $15,000 debt, you'd still pay about $3,200 in interest before becoming debt-free. That's thousands of dollars leaving your family's economy forever. What if there was a completely different approach, one that financial institutions definitely don't advertise because it directly threatens their profit? There is, and it's been hiding in plain sight. The solution might surprise you. Properly structured whole life insurance policies. Now, before you roll your eyes, this isn't about the death benefit. This is about using a specific type of whole life policy as your own personal banking system. When structured correctly, these policies allow you to borrow against your cash value to pay off high interest debt while your money continues working for you. Instead of paying interest to credit card companies, you're essentially paying yourself. This means you could potentially eliminate that credit card debt years faster than conventional methods, while simultaneously building a growing pool of capital that continues working for you long after your debt is gone. That growing pool of capital isn't just some financial theory, it's the foundation of what insiders call the infinite banking concept. The wealthy have been using this strategy for generations while the rest of us are taught to depend on traditional banks. But what if you could replace the banking system you've been fighting against with one where you make the rules, collect all the interest, and never have to apply for credit again? The strategy I'm talking about is the infinite banking concept, or IBC, formalized by Nelson Nash in his book Becoming Your Own Banker back in the 1980s. Nash wasn't creating something new, he was simply documenting a financial strategy that America's wealthiest families have been using for over a century. The Rockefellers, the Morgans, even Walt Disney used specifically designed whole life insurance policies as their personal banking systems. Now, I need to make something super clear. This isn't about the death benefit of life insurance. That's what most people think of when they hear whole life insurance, but that's just scratching the surface. We're talking about transforming a financial product into a personal banking system that gives you total control. So what's the big difference between traditional banking and being your own banker? When you use a traditional bank, you're the customer. You have to apply for loans, submit to credit checks, pay whatever interest rate they decide, and follow a repayment schedule. But when you become your own banker, you make all the decisions. You approve your own loans, you set the repayment schedule, and most importantly, you capture all the interest payments for yourself. To build your personal banking system, you need three key components. First, you need cash value, money that grows tax-free inside your policy that you can access at any time. Second, you need dividends, which are your share of the company's profits when you use a mutual company. And third, you need policy loans, the mechanism that allows you to borrow against your policy's value without withdrawing your money. Not all whole life insurance policies work for this strategy. In fact, most don't. You need a policy specifically designed for banking, not for death benefit. This means looking for policies with high early cash value, low commission structures, and the right riders attached. The policy needs to be from a mutual insurance company, not a stock company. This distinction is crucial because with a mutual company, you're literally a partial owner of the company. The dividends you receive aren't just interests, they're your share of the company's profits. These mutual companies have been paying dividends consistently for over 100 years. Even through the Great Depression and every financial crisis, companies like Lafayette, MassMutual, One America have dividend payment histories stretching back to the 1800s. When you're setting up a banking system, that kind of stability matters, something that trips up a lot of people. The policy structure itself. Most insurance agents will try to sell you a standard whole life policy because that's what they're trained to do. For infinite banking, you need a policy designed with high cash value components and a relatively low death benefit. This is actually the opposite of how most policies are structured. Let me show you what I mean by a properly structured banking policy. You could have access to up to 90% of your premium the first year. So if you put in $30,000, you'd have access to about $27,000 available to use immediately. By year 5, that could grow to $150,000 or more in cash value. By year 5, that could grow to $150,000 or more in cash value, and unlike a 401k or IRA, you have access to the money at any time for any reason with no penalties or taxes. The best policies for creating your own banking system are dividend-paying whole life insurance policies from mutual companies with specific riders like the paid-up additions rider and properly minimized base premiums. These policies allow you to front-load cash growth while maintaining the tax advantages and creditor protection that life insurance provides. Now that we understand the basic ingredients, let's examine how to actually structure your policy, because this is where 90% of people get it completely wrong. The difference between a properly structured banking policy and a standard whole life policy isn't just significant, it's the difference between financial transformation and just another expensive insurance product. When we talk about policy structure, we're talking about the specific arrangement of premium allocations and riders that determine how quickly your cash value grows and how efficiently you can use your policy for the banking purposes. Let's get into specifics that your insurance agent probably won't tell you. First, here's something critical. Most insurance agents will naturally try and sell you a policy that maximizes their commissions rather than your banking potential. Why? Because standard whole life policies pay agents 50% to 110% of the first year's premium as commission. So if you're putting a $30,000 policy, an agent could make $15,000 to $33,000 just from selling you that policy. And it's no wonder that they push these. But for proper banking, you need to minimize the base premiums and maximize what we call the paid up additions rider. This rider is the secret sauce that allows you to dump in large amounts of money into the policy while keeping the death benefit relatively low. When structured correctly, this approach drastically reduces agent commission, typically around 15 to 20% of the first year's premium, but it maximizes your first year cash value. Two other riders you need are the waiver of premium rider and the guaranteed insurability option. The waiver of premium ensures that if you become disabled, the insurance company continues making your premium payments for you. The guaranteed insurability option allows you to purchase additional insurance at standard rates regardless of the health changing in the future, which gives your banking system room to grow. Now, there's a critical balance you need to strike in funding your policy. If you put too much money in relatively quick, you'll trigger what's called a MEC status, or a modified endowment contract, which eliminates many of the tax advantages. But if you don't put enough money in, your cash value won't grow quick enough to be useful for banking. The ideal ratio, often referred to as a 45-65 split, where roughly 65 of your premium goes to those paid up addition riders and only about 45% goes towards the base policy. This policy would maximize the long-term growth of the policy while maintaining the policy's tax advantage status. When looking at policy illustrations, focus on three key numbers: first year cash surrender value, policy loan availability, and non-guaranteed elements. A properly structured banking policy should give you access to about 60% to 90% of your first year premiums as cash value right away. By year 5, you should have access to more than your total paid premiums, and by year 10, you should see significant growth above and beyond what you've contributed. This structure is radically different from what most agents will show you, where you might only have access to 40% or less of your money on the first year. On a $50,000 premium, that's the difference of $15,000 or more in accessible cash in the first year. So let's talk about numbers. With a properly structured banking policy and a $50,000 annual premium, you could have approximately $42,500 available in year 1, and around $125,000 by year 3, and potentially $275,000 or more by year 5. Compare this to paying down credit card debt conventionally, where you'd have $0 working for you after 5 years, and you'd have paid thousands in interest to credit card companies. When looking at different infinite banking policies, always ask potential agents these specific questions. How much of my premium goes toward the paid up additions rider? What percentage of my premium will be available to me as cash value in year 1? And have you personally used this strategy with your own finances? If they can't answer these questions clearly or seem hesitant, just keep looking. Now, how do we implement this? Once your policy is properly structured, it's time to turn to the insurance carrier contract into a financial weapon against credit card companies. The banking system has profited from the average American's financial ignorance for decades, But now let's flip the mathematical advantage completely in your favor. So here's where policy loans enter the picture, and they're fundamentally different from any other loan you've ever taken. When you borrow from a bank, they check your credit, charge you interest based on your risk profile, and set terms for repayment. But with a policy loan, none of that happens. Instead, when you take a policy loan, you're not actually borrowing your own money, a misconception that many people have. You're borrowing against your policy, using it as collateral. The insurance company is lending you their money while your cash stays intact inside the policy. This is absolutely crucial to understand. And here's the real magic. While you have this outstanding loan, the entire cash value continues growing as if you'd never touched a penny of it. This uninterrupted compound growth is the secret sauce that makes infinite banking mathematically superior to a traditional debt repayment strategy. Let me walk you through exactly how this works in practice. Once your policy has cash value, you simply call your insurance company or log into your online portal and request a loan. Most companies can direct deposit the funds within 3 to 5 business days with no credit check, no application, and no questions about how you'll be using the money. Now, let's say you've accumulated $20,000 in cash value. You request a $15,000 policy loan to completely pay off your credit card. The insurance company sends you $15,000 and you immediately pay off your credit card balance in full. But here's the key. That entire $20,000 in your policy continues growing at the same dividend rate as if you never took out a penny. Your insurance company will charge you interest on the policy loan, typically around 5% depending on the company. But remember, your money is still growing at the policy's dividend rate, which historically has averaged 4 to 6% in today's environment. So the effective cost of borrowing really is just the spread between the two rates, which might only be 1 to 2%. Now, instead of making minimum payments on the credit card, you'll make payments back to your policy. But here's a crucial difference. You're now recapturing the interest back into your own system instead of sending it to a credit card company. Every dollar of interest you pay goes back into your policy's cash value, further increasing your wealth. Now, let's take Sarah, for example. She accumulated $52,000 in credit card debt across 6 different cards, with average interest rates ranging from 17 to 24%. After setting up her infinite banking policy with $65,000 in cash value, she took out a policy loan at 6% and completely eliminated all of her credit card debt in one fatal swoop. Her previous payments to the credit card companies totaled about $1,500 per month, with nearly $1,100 of that going to interest alone. She structured her policy loan repayments for $1,500 per month, the exact same amount she was already paying. But now all that money goes back into her policy. And here's the incredible part. Even though she had a $52,000 loan against her policy, her cash value continued to grow. After just 12 months, her policy had earned dividends of approximately $2,900, while she paid out about $3,100 in loan on the interest. The net cost of borrowing was only $195 for this entire year, compared to the $13,200 in interest she would have paid to the credit card companies. To implement this strategy yourself, follow these steps. First, take out a policy loan for the exact amount of your credit card debt. Second, immediately just pay off the credit cards in full. And then third, just establish a structured repayment plan to your policy that matches or exceeds what you are paying to your credit card companies. And then fourth, just maintain discipline. The strategy only works if you actually make those payments back to your policy. What makes this approach so powerful is that you're essentially transferring the role of banker from the credit card company to yourself. Every interest payment you make now builds your wealth rather than someone else's. And unlike traditional debt repayment where your money disappears forever, here your money continues working for you even while it's used elsewhere. Now, let's put some numbers to this strategy and see what happens when you compare your old financial path with becoming your own banker. The difference isn't just impressive, it completely transforms your financial trajectory over time. When we compare side by side what happens to $50,000 in credit card debt handled the traditional way versus your banking policy, the numbers tell a compelling story. Let's break down how this looks over different time horizons. With a traditional credit card repayment using extra payments of $1,500 monthly on a $50,000 debt, with traditional credit card repayment using extra payments of $1,500 monthly on a $50,000 debt at 20% interest, you'd finally become debt-free after about 42 months. During that time, you'd pay around $16,300 in interest, and that's $16,300 gone forever. Money you can never recover or invest anywhere. After those 42 months, you've freed up about $1,500 monthly, but you're essentially starting from zero in terms of wealth building. Now, let's look at the banking policy approach. After establishing a policy with sufficient cash value to take out a $50,000 loan at 6%, you'd make almost the same $1,500 monthly payments back to your policy. The key difference, you'd eliminate the credit card debt completely. And now those payments are building your wealth instead of the credit card companies. After 42 months, the same time frame, you would have paid roughly about $6,600 in simple interest on your policy loan. Meanwhile, your cash value would have continued growing at the same dividend rate. Assuming a conservative 5% dividend rate, your money would have earned about $5,800 during this period. That makes your effective interest cost only about $800 over this entire period. Compare that to $16,300 with traditional repayments. But this is just the beginning. The real magic happens after the debt is gone. In year 5, when the traditional approach has just started freeing up cash flow, your banking system already has substantial cash value that's been growing the entire time. By year 10, the difference becomes even more dramatic. Let's say you continue directing that $1,500 monthly payment into your policy after paying off the loan. By year 10, your policy could accumulate over $225,000 in cash value. Meanwhile, the person using the traditional approach who then started investing the $1,500 monthly would only have about $108,000, less than half of what you've built. By year 20, this gap widens to something truly life-changing. Your policy could grow to over $750,000 in cash value, while the traditional approach might reach about $450,000, and that's a $300,000 difference by just changing where your money flows. This perfectly illustrates what we call the velocity of money, how quickly your dollars can be recycled and put to work. In a banking policy, your money is always working for you, never sitting idle, and generating multiple layers of benefits simultaneously. To track your policy's performance and optimize your strategy, you should review these 3 key metrics annually: your cash value growth rate, your dividend performance, and your policy loan efficiency. Most policy owners schedule an annual review with their agent to evaluate these numbers and make adjustments if needed. What's fascinating is how this system continues working long after your traditional debt is eliminated. For example, a business owner I met with from Colorado who initially set up his policy just to deal with the $35,000 in credit card debt. After eliminating that debt in just 3 years, he continued funding his policy. 10 years later, his cash value had grown to over $320,000, which he used to purchase rental properties without going to a bank. Today, he owns 6 properties, free and clear, and purchased them all through his banking system, while this policy continues growing. So you've seen the full picture now, and let me give it to you straight. What I've shown you today isn't some get-rich-quick scheme. It's the exact mathematical approach that financial institutions have been using for generations to build wealth slowly but surely. The difference is now you're the bank. This system gives you something that is truly powerful. It's control over your money. While others continue giving their interest away to credit card companies, you're recapturing that money back that's in your own system. That's the difference between financially educated and financially exploited.